this year so far. Last year, if you remember, and some of you do remember, the S&P 500, which is one of the largest indexes in the U.S., was sort of the best performer. And there's always this question between value and growth when you're investing in the market. And growth actually outperformed value last year. The NASDAQ did really, really well, which of course is mostly in the tech area. Commodities, the couple big themes, which we'll get into in more depth. Commodities were a bit of a problem. Rita, sit down. And, that's what I used to always do in school too. If I didn't get in the front row, then I was always a little naughty. So we went the naughty girls in the front row. Now when the teacher can touch you on the shoulder and make you calm down. So anyway, so commodities, as you know, are anything from orange juice to lumber to silver. I have a background originally trading on a currency and all the gold, silver, platinum. And all that stuff just blew up last year. I don't know if anybody paid any attention. If you're in the jewelry area, you certainly did, because you're trying to get either things replaced or fixed. Now's a good time. But when you look at what happened in the U.S., basically, you're looking at large cap companies doing very, very well. People forget that 10,000 people a day are retiring in the United States. And where are they going to put their money? We're in a zero interest rate period. We've had interest rates go down for 30 years. And we'll get into talking about rates here in a second. We're about to see rates go up for the first time since, basically, we had 5 interest rate raises in 1994. Does anybody remember that period of time? Yes. It was ugly. Okay, so the reason it was ugly is that people were not prepared from a fixed income side. And everybody always assumes that their fixed income is safe. When interest rates start to rise, the actual principal in your bonds can be lost, depending on how long the bonds are. So if you're talking about, nobody buys 30-year bonds, they're still issued. If you're buying 20-year bonds, even 10-year bonds, you're going to see fluctuations start to go with the pricing of those assets. So when fixed income, and the Fed should be raising interest rates, I'm going to make a guess here, with my beanie cap on, sometime in September. It'll be a slow, gradual rate increase. Now, why are we doing this? Well, there's a lot of reasons, which we'll get into both. We're going to go back and forth here in a second instead of me dominating. It has a lot to do with U.S. economy is actually doing quite well right now, even though some of the consumer numbers aren't there exactly. Jobs growth has been fairly consistent, and basically, let's be honest here, the Fed's done everything they could possibly do in order to make the rates go down and to create liquidity in the U.S. markets. And it's worked. I mean, we were looking at the precipice in 2008, which everybody seems to have forgotten. And now we're looking at a period of time where we're getting into the growth area. So we're going to see small caps do quite well, and there'll be some rotation that's already started to happen. We've got the U.S. dollar that's done fantastically. I had a client text me last night. She was in Rome having a very good shopping experience. I was wishing I was there. But yeah, so right now is a great time to be overseas purchasing things.
So let's take a step back a little bit and talk a little bit first about the U.S. economy and how that contrasts with global economy and Europe and Japan especially. So I think what's very interesting right now, if we contrast the economy in the U.S. and evaluations where we're today with what we see globally in international markets, we at BlackRock actually think that there may be better opportunities to invest internationally. So if you have a very large overweight in U.S. equities, you may actually want to start consider sort of taking that down a little bit. And this is while, since the financial crisis, the U.S. economy is actually sort of the bright spot of the global economy. Debt levels have been coming down, unemployment has been taken down, equity markets have done really nicely, the same thing for real estate. People are able to sell their houses again, they're above the water mark and able to move for jobs. If we look at the most recent data, we actually just saw the GDP number for the US for the first quarter come out yesterday. It was actually quite soft. And what's happening there is that we've had a cold winter in many parts of the country. We've had closures of ports on the West Coast. And we've had consumers that have taken the windfalls from the lower energy prices, lower gas prices. And instead of actually spending that, which we would have seen in retail sales, they've actually gone ahead and saved that money. So there's been little growth in consumer spending that would have supported growth through the first quarter. As a result, U.S. economic surprise indices have been ticking down, and they're actually at multi-year lows today. And that's relative to Europe and Japan, where the recovery has been a lot softer. In Europe, for example, none of the 17 nations in the Eurozone are currently able to meet the European Central Bank's inflation target of 2%. Japan went to a technical recession last year in the third quarter. They hiked their sales tax or consumption tax, and as a result, spending plummeted. But what's very interesting is that some of the recent indicators out of these two regions, especially in Europe, have been actually quite promising. So while in the US we're seeing some of those economic indicators ticking down, in Europe especially, we're starting to see some firming of that data, whether we look at the labor market, growth indicators, inflation, and so on. And this is against the backdrop where US equity valuations at this point of the recovery are arguably quite full. We're actually underweight US equities at BlackRock today, mainly thanks to valuations.
So is Morgan Stanley.
So is Morgan Stanley. While in Europe, especially earlier this year, end of last year, valuations were on a relative basis a lot more compelling. And in Japan, there's arguably still a lot more to go. So for that reason, we think that there's perhaps better opportunities internationally. And what really helps this is that what Theo was talking about was the Fed stepping back and looking to hike rates. Both in Europe, in the Eurozone, and in Japan, monetary policy continues very, very accommodative. And if anything, there's, especially in Japan, expectations of even more accommodation down the line, perhaps during the fall. And this helps, especially with investor sentiment, but also arguably on the ground. And for those reasons, we think that you might want to start looking internationally for perhaps sort of better valuation investment opportunities today than just sticking to US equity. And with that, I think I'm going to turn back to Theo and let her talk about the expectations for the Fed, the rates, and the implications of that for the market.
So the first comment I meant was that we're looking for the first 25 basis points or 0.25% increase sometime in September. Although, this morning there was some commentary on by Bill Gross, of course, who's now gone to Janus. And I love how everybody switches seats. Bernanke is now going to PIMCO. And as you know, all these guys get to move from place to place to place and keep jobs. One of the things that people don't know about, which I'm just going to throw this one under the boat here for the Federal Reserve, and you'll notice also that a lot of the guys are from Goldman Sachs. For you to take that job in the Federal Reserve coming from the private sector, you are allowed by law to take all of your retirement earnings, all of your options and your pensions, and turn them into a tax-free, everything that you've made, and put it into a tax-free situation. So they do not pay taxes. So anybody realize this when that's one of the reasons people go into these positions, so they get a pass because they work for the federal government.
In addition to that, sorry to interrupt, in addition to that, they have much less stringent insider trading rules once you're sitting in the Fed than you would have at Goldman Sachs.
Yes, and so they do end up, a lot of them end up at hedge funds and other places, obviously, afterwards, because it's very profitable for them. Average speaking engagements run 100,000 and up. Of course, Hillary's getting 250,000. We just had her speak down at Lead On. Quite a few of you were there. I spoke right after her, which was kind of a tough position. And I realized that I had to tell jokes. I may tell some later today when I warm up. I'm still not completely awake. But going back to Fed rates. So if we go back to 1994, there were 5 Fed rates in 1 year. And having been in the bond market forever and having been on the bond desk, you saw like $1 million in 1 year lose 20%. So hopefully, and they're trying to be very careful about this. And of course, as they always say, if you want a job done by a woman, give her a hard job, right? So poor old Janet Yellen is in one of the toughest positions we've ever seen. And of course, it's the first female we've ever had in that position. And she's got her foot on the gas and her foot on the brake simultaneously right now, because it's a critical period of time. If you know history back in 1937, let's go back to the Depression for a moment, they too quickly put their foot on the gas and raised interest rates too quickly and caused huge problems. Now the good news is they do have that history footprint. The likelihood of that happening is next to nil. There's very different situations right now, but you have to stop and think about history. whatever these economic series go on. So, when you're talking about the fixed income, again, I'm not representing Morgan Stanley here, even though we happen to agree with most of what she's going to say, particularly about BlackRock. Think about your fixed income positions. They will decrease in principal. If you own anything that's particularly tied to housing, Ginnie Mae, Fannie Mae, those sorts of things, they are the most sensitive, along with a few other things, CDOs, etc. You'll find that those will lose their face value. What does that mean? So you put $1 million in and interest rates start to go up. You lose principal unless you're very, very short. Very, very short, very, very hedged, available to take advantage of rates going up as opposed to losing money. So make sure you really pay attention to that, because I know Joe Q public is going to get screwed again, and because they don't understand this. So it's a basic law. We've had interest rates going down for 30 years.
We actually expect the longer-ended Treasury bonds to be perhaps more shielded from the Fed rate hikes. And that is because international investors who are looking for higher yields, are taking money out of their domestic markets and parking that into longer treasuries especially. So for that reason, unlike we've seen in history, it may actually be the short end of the curve that is going to see more of an impact than the longer sort of dated treasuries. It's just something to keep in mind. So we actually prefer sort of at the middle end, if you will. Now, talking about energy, so one of the implications of the rate hikes is obviously on, as Theo mentioned, on the level of the dollar. So one of the main reasons the dollar has been driven up until recent weeks this year was the expectations for the Fed to be the first big central bank to start hiking rates. Now, the implications of the stronger dollar are many-fold across the financial markets. One of the main ones is actually on commodities and energy specifically, because it is denominated in US dollars. So to the extent that you see strength in the dollar, you expect to see softness in the commodity space. And that's been one of the reasons that energy has been quite soft, again, up until recent weeks. The bigger backdrop for oil prices especially is effectively an oversupply in the market. So we've seen a supply-demand imbalance. The US currently is producing, thanks to the shale oil boom, more oil than it has for several decades. And quite unexpectedly, we actually saw supply coming into the crude oil markets from those Middle Eastern countries like Kurdistan, Iraq, Libya, etc., that had seen unrest as supply sort of drawbacks earlier in the year. And that's against the demand backdrop that has been quite soft, given that the economic recovery has been relatively soft in Europe and Asia especially. Now, most recently, we've started seeing more stabilization both on supply and demand. US producers are cutting rig counts, and if anything, May is actually expected to be the first month when even supply is going to go down in the US. On the demand side, we're seeing more firming as per the industry associations already now, and especially expectations of that in the second half of the year. Saudi Arabia, for example, have raised their prices a couple of times for their Asian customers, which is really indicative of what's happening in the markets, because it is still the largest producer in the world. And through that, we're seeing more stabilization in the oil markets, which we actually do expect to continue. One of the interesting implications of that is on positioning across countries and emerging markets especially. So you may remember a couple of years ago when the expectations started abounding about the Fed starting to dial back its quantitative easing program, so effectively starting to taper its asset purchases. How much of an impact that had on, especially some of the riskier markets out there, some of the emerging market countries like India, Indonesia. Now, relative to that scenario, today we have an additional dimension to the story, which is that of oil prices. To the extent that oil prices continue still relatively low relative to historical standards, we expect countries that import a lot of oil, India, Indonesia, China, to actually benefit from that, and therefore to be more shielded from rate hikes. Whereas the producers, exporters like Russia, And some of the other commodity producers like Brazil are likely to be more under stress. So it's an additional dimension to keep in mind when you think about your country positioning in the second half of this year.
I'm just going to talk quickly about, and I will mention that we did change our allocation on real estate investment trusts in the United States last week. This was a big move. They're also most sensitive to interest rates rising. We basically took a position of about 5% of our global investment committee portfolio from 5% to 0. So people always say, what's going to happen in real estate? Now this has more to do with an interest rate plan, the fact that interest rates are going to go up. But I'm one of these people that likes to talk to clients that happen to own a lot of real estate. And I can tell you that in San Francisco, let's just talk about the Bay Area, that actual rent prices peaked at the end of January. So for a place, a condo, two-bedroom condo with decent views in a good neighborhood at $5,500, they could not rent it at that level. It came down to about $5,100. Nobody's talking about this. So the rent prices have peaked, which is always a preeminent thing to look at. If you look at the Schiller 20 city indexes, that also had a peak period that occurred in February, which is not to say, San Francisco is a little different than everywhere else in the world as far as pricing, but it's a great seller's market, let me just put it that way. And so I think there'll be some opportunity for people, particularly the younger people in this room, that at some point the pricing, as we go to regression to the mean, should be a little cheaper and make it easier as interest rates start to go up. There'll be some jitters there. We do still like global real estate investment trusts and global real estate in other parts, obviously in the United States. As Nellie said, U.S. markets are fully valued at this point. There are sectors that are a little bit cheaper. Those are the ones you want to pay attention to, but our emphasis is also overseas right now.
So what we're going to do today in the very limited time that we have together is I'm going to give you a very rapid fire look at where the future is moving. But before I do that, in order to really understand where the future is going, we need to look back. So I'm going to go through a very quick history lesson and tell you where we see the economy moving in the future. So around 2008, one of the questions that we kept getting from our clients, as I'm sure all of you can imagine, was, of course, when is the global recession going to end? And we said that it was a question that we couldn't answer, not because we weren't able to answer it, but because it was not just a recession. Rather, what we saw was that it was a fundamental transformation and a fundamental restructuring of the entire global economic landscape on a scale that we had not yet seen for decades. And we've had similar pain points throughout history. So when we look back, we were in the agricultural economy for thousands of years. We then transitioned to the industrial economy. We were there for about 250 years. We moved into the post-industrial economy. We were there for about 50. We then hit a similar pain point where we went into what we call the immotile economy. Other people were calling it the information or the knowledge economy. And then right around 2005 to 2008, we hit a similar pain point. So I always think of it as kind of two tectonic plates crashing together. And when we come out the other end, everything will look completely differently. We're not going to go back to that which came before. So we see three major things happening here. The first is the confluence of disruptive technologies. The second is the commoditization of those technologies. So that which we once used to make money on, we no longer can make money on anymore. So we must migrate to the next higher order value proposition in order to court that consumer. So let's take cell phones, for instance. They used to cost a fortune. They used to be twice the size of this microphone. And a company used to make money by selling that hardware. But now, because it's become so commoditized, so democratized in so many ways, you can only make money on the adjacencies. So that company must migrate up and court the consumer in a new way. The third thing, which is really the most important, is the collapsing of time frames and the speeding up of time. As you can see, we went from thousands to hundreds to mere decades to now it's just a matter of years. So these three things are really leading to the new economy. And we asked ourselves, in order to frame and contextualize where this new economy was going, three questions. The first was, where is disposable income going? The second question was where are jobs being created? And the third question was, what is the MO? Basically, the modus operandi, what is guiding and framing this new economy? And we looked back on all of our trend research and all of the data that we had collected for years, and we had piles and piles of this. And we identified 10 major growth areas. All of them, the MO, we said was about altered dimensionality, and that dimension was space. If we had more time together, I'd go into that. But we identified 10 of these major growth propositions, and as such, we called it the meta-space economy. But the first one I want to cover, and I'm going to ask you guys a question first. If I was to ask all of you in this room, using a very basic economic equation, what in your life is in high demand but short supply? What would you say? Time. I love asking a group of women this, because I always have, no offense to the guys in the corner, but I've had the guy in the back being like, sex. And I'm like, what kind of answer is that? So yes, time. Time is the number one new value proposition in this new economy. And one of the questions I'm always asked is, after the meta-space economy, what's going to be next? And I would say that the next economy is going to pivot all around time-space. But time-space is the first growth area that I'm going to cover today. And basically, it's what I said. It's one of those three things that's really framing this economy. It's the speeding up of time. And it's happening not at a geometric rate, but rather an exponential rate. And the word we have for this, and we're always in the business of coming up with new words. We actually have a glossary on our new website, because when we say in order to really understand where the future is going, you can't get bogged down or saddled by existing vocabulary. So our word for this is templosion. It's basically the implosion of time into smaller and smaller chunks. And this is happening in all facets of life, and I'm going to breeze through several areas in which this is happening. The first is, raise of hands, how many of you have heard of collaborative consumption? A few of you, yeah. We're kind of in the birthplace of it here. It's the rise of the share economy. It's the Ubers, the Rent the Runways, the Airbnbs, all of these businesses that are now cropping up. That it's a time value proposition here. And for a lot of younger generations, they value time in a new way. And what's happening around the share economy is that what it really represents is a fundamental value shift. It's a value shift from ownership to that of access. And they just want access at any point, at any time. It doesn't matter when, where, or how. And this is not a global trend. Oftentimes we focus just on what's happening in the US. The US and much of Europe is bolstering this trend. But as we look at younger populations in Asia, particularly China, this is a trend that has not yet caught hold, because they are very much about conspicuous consumption, and ownership is a value that they still have. But that's just one aspect of time-space. Another has to do with communication. So let's look at how communication now is evolving. If we look at our ancestors, the cave women from forever ago, how would they communicate? Through pictographs or through cave drawings. Then we migrated to the written word. Then with the advent of the internet, the written word migrated online, and then it became truncated. So we went from blogs, then we went to microblogs, then we went to limiting our communication to 140 characters on Twitter. And now to younger generations, that even seems cumbersome, so much so that they are truncating it even further. And then we see the rise of things like Snapchat, which is a dissolvable form of social media, where kids now are communicating just through pictures and imagery. So the question is, does this represent the evolution of communication, or is the devolution of communication? Are we communicating the same way as our very ancient ancestors once did? But it's also about time. We know, for millennials, they are keenly aware of something we call e-me for eternity. Basically, you put it out there on the internet and it's not going anywhere. Gen Z, and I'm going to get into, of course we have a new word for Gen Z, they know that that is there to stay. They know that Anything they put online is going to be there when they're applying for college, when they're applying to their first job. So they want that temporal form of media. They want it there for 30 seconds and then it's gone. So we also see something else that we call, you guys are going to leave here with about a dozen new terms, something that we call the growth of the non-linear life trajectory. So what does this mean? Basically, this is the idea that life is going from something that was once linear and sequential to something that is now multi-layered and simultaneous. So what do I mean by that? Stages of development used to follow a very linear path. We would go from childhood to pre-adolescence to adolescence. We would go into college, we would have our careers, we would get married, we would retire. It was all very linear. Now, for one, economic realities are making it so that many graduates right out of college have to move back home with their parents. Many baby boomers who have been thrust out of the economy and need to start on par with those who are right out of college are moving back in with their kids or are starting careers from scratch. And one of the other things that collaborative consumption is doing is giving rise to the collaborative society or the collaborative economy. So I would argue one of the things that we oftentimes focus on is what's going to replace the middle. We see the bifurcation of labor in terms of higher tech, high-skilled, high-wage jobs. And on the other end of the spectrum, the kind of blue-collar, lower-wage jobs with the dearth in the middle. And I would say one of the ways that this middle is reinventing itself is through the collaborative workforce. It's the cobbling together of micro gigs or temporary labor. So it's the person who might be a contractual freelancer during the day and an Uber driver at night. It's these, as I said, these strung together micro jobs. So we're not seeing employment follow a linear trajectory as well. And this is becoming the norm for a lot of young people. They no longer see their life path as following this one straight line. Another aspect of this is that we can live many lives at once. And one of the other growth areas, and I'm going to quickly cover it after this, is cyberspace. And we see that through virtual reality immersion technology, we are able to create an avatar and live both in a virtual world and in the real world. We can have one identity at work. We can have another identity in either a massively multiplayer online game or in a virtual world. And we can live simultaneously as different personas. And I would always say that younger definitions of success, in the future I would define it as one's ability to seamlessly move back and forth between the real and the virtual. So again, notions of time and time as being linear are all becoming more skewed. Another way that this is manifesting itself is by the rate of generational change. Right now we also view generations as very linear in kind of very concrete demographic buckets. So we see the baby boomers, we see Gen X, Gen Y, the millennials, and now Gen Z coming up behind them. But because, again, I go back to what I said about the rate of technological change, since it's happening at an exponential rate, then the way that we segment generations honestly makes absolutely no sense. So I am technically a millennial. I was born in 81. My husband was born in 79. We met in college. Demographers have us as members of two very separate generations. But our access to technology was the same. We didn't have Facebook in college. I had my first cell phone in college. We still had to go to the library to research things. A peer of mine, maybe 3 years younger, their experience at college might have been completely different with the advent of Facebook. They had their own cell phones when they were in high school, the way in which they communicated. I mean, I met my husband through literally a physical Facebook, and I tell this to someone who is in their mid-20s, and a physical Facebook with your headshot, that's tangible, what does this even mean? And these notions, so the fact that I am lumped together with those who are now 24, 25 years old and even younger, doesn't seem to make much sense. What would make more sense is rather we should define generations every 2 to 3 years. And because things are happening so quickly that that someone's frame of reference becomes so skewed. So when we look at what's coming up behind the millennials, and so many people have focused on the millennials, so many positive and kind of negative attributes associated with them. But what particularly excites me is what's happening quickly coming up behind them, what we refer to as Gen Z, or, of course, as I said, we have to give them a new name. We call them cybrids, cyber hybrids. And it is not to evoke any sort of sci-fi notions of cyborgs, but rather cybrids are named as such because they are the first generation in history to have a truly symbiotic relationship with the technology that surrounds them. So if you think about it, these are the ones who are wired completely differently. And one of the other growth areas is inner space. And that is all about the understanding of what makes us tick. It's neuroscience and the neurification of everything. And when we look at this generation in particular, it is the first generation that has actual different neural wiring. So we oftentimes focus so much on attention and boredom, and it's no wonder that these kids cannot pay attention because they are literally wired differently. So oftentimes we blame the technology versus just understanding what makes them tick. And we put them into such an antiquated school system, and a school system that was appropriate for an industrial age economy based on rote memorization and being there for a fixed number of hours. When they are not, what did I say about time? It is multi-layered, their brains are multi-wired. So instead of understanding how to teach the new brains, rather we drug the brains or we tell them that they have attention deficit disorder or ADHD. And there are some that are looking to new ways to teach. In some places in South Korea, for instance, they are looking at using virtual reality, where 3D printers are being put into the classroom. But we have a long way to go before we truly understand how these cybrids learn, how they think, and what's going to be most appropriate for them. And for those that are at the very beginning end of this generation, those who are just leaving college now, let me back up. The average millennial has had 7 careers by the time, or 7 jobs by the time they are 30. And I don't think the cybrids are going to be any different, because the way that they are going to view labor and work and employment is also going to be completely different. So it's no wonder that when they go into some of these very siloed or hierarchical organizations, they get bored or they blow up within them, because it's like putting a square peg in a round hole. They just don't think that way. A couple exciting things, though, for me about this generation. They are highly, highly entrepreneurial. They're not even interested in going into those sorts of hierarchical companies. They want to create their own. We see so many 15, 16-year-olds now with their own TED Talks or have created their own businesses. We oftentimes talk so much about mentorship, but one of the things in the future that's going to be so important is the idea of reverse mentorship, because they are up to date with the technology. I have a 16-year-old mentor. He's brilliant. He has 2 companies already. And he tells me what's going on with his peers, what's happening technologically. And he probably is a dinosaur compared to so many of the 12 and 13-year-olds out there. So my suggestion for all of you is to tap into some of these younger brains, tap into these cybrids, because they know this technology and they are creating that technology. I mean, look, we're here in the Bay Area where so many of them now are being hired into all of these very cutting-edge companies right out of high school, many of whom are bypassing college altogether. So their values are a little bit different than the millennials. So we need to make sure to understand how they are different, and as I said, what makes them truly tick. Another growth area is cyberspace. So everything that's happening, as I said, with virtual reality, we're going to be working there, living there, playing there. Also under cyberspace is what's happening with alternative and digital currency. So I say Bitcoin is not going to be the future. It is the first successful, semi-successful beta test, but rather it will spawn so many future iterations as it already has. So that is going to completely disintermediate the future of finance, banking as we know it today, traditional payment systems. All of that is going to be completely upended. And these cybrids are going to be creating their own currencies. So one of the questions I always pose when it comes to digital currencies is that there are those that think this could be the end of a money monopoly, and there are those that think that this is just a newfangled version of monopoly money. I would say it's somewhere in the middle. So to truly understand where these are going, as I said, Bitcoin is a good beta test, but countries, municipalities, everyone is going to be creating their own. Another growth area is play space and play. We are coaching play out of our young people today. Cybrids, because they're so connected to technology, are not out there playing, and as such, we've also coached it out of our adults. We're seeing a new movement towards adult play both in the workforce and some new urban areas, or even putting in adult playgrounds. So we're going to share a lot more about play. This also encompasses the rise of gaming and gamification. The difference is that gamification is really all about the leveraging of gaming mechanics in a non-game setting. So it's rewards, it's leveling up. For young people in the workplace who are more intrinsically than extrinsically motivated, they're not interested in money, they are interested in gamification in the workplace. These are major tools to productivity and motivation, so they would rather be rewarded, or even through different feedback mechanisms, just put on social media and told by their peers, Mary did a great job, let's give her a virtual clap, than actually giving her a raise. And another part of this is the rise of e-gaming. So a lot of kids, also because of attention spans and boredom, cannot pay attention to traditional sports. Baseball is declining rapidly, and we are seeing so many more young people interested in becoming not athletes, but e-fleets through e-gaming. And we also see the rise of e-doping. So students now in college are doping and taking drugs to basically stay up longer and compete in these online games. And then the last one I'm going to cover very quickly is design space. And we always think of design of physical products, but rather design and design-based thinking are going to become major managerial competencies in the future. And one way that this is manifesting itself is in the design of the physical workplace. We have a concept we call workplace science. Science is basically an acronym for designing around serendipity, cultural fit, interactivity, empathy, what I was calling namaste or mindfulness, collaboration, and engagement. So more of the workplace is going to increasingly pivot around these different areas, and young people are going to gravitate to companies that really leverage these different variables.